Welcome to Super Money. I have made one video. I had made one video long back. Maybe I'll put it back again. Is the rule of 3, 20, 30, 40 for buying a house. So I had said you should make 40% down payment while buying a house, because that will be a stress-free environment for you, because even if prices were to go down, if between the couple one of them were to lose their job, there still the EMI would be more affordable. So yesterday somebody asked me, should I ever put more than 20% down on making a home purchase? I have a very simple answer. This question is almost unanswerable, because it depends on how the market performs over the next few years, and how are you going to judge me. Are you going to judge me over 2 years, 3 years, 5 years or 20 years? If you're going to judge me over 20 years, then there is absolutely no question. You should put money, you should put only 20% down. But if you're going to judge me over 5 years, if you're going to judge me, if you're already nearing retirement age, if you're a person who does not invest in anything other than bank fixed deposits and the great endowment plans, then you should put down 40%, because your alternative investments is not earning too well, right? So, and of course, this person was asking this question saying that if I take a floating rate now, and knowing that RBI will cut rates over the next few years, I should benefit because of lower interest rates, and I will be able to earn more than that in my alternative investments. Look, if the RBI starts cutting rates, maybe 1 or 2 more cuts, I think you would have reached a very nice level of home finance, all home refinance rates. After that, it may not hit too low. So in India, the range could be anything between 8% at the bottom. You will not get money at less than 8% when you borrow for a house, maybe 7.9 or something, which are teaser rates perhaps, and to a high of 11%. So that's the range. So when interest rates are low, or let's say now you can get money at 9% and you think it will go down to 8%, it's a great time to be putting down only 20% and putting the balance into other places where you can earn more, maybe a mutual fund, a PMS, or direct equity, whatever. But it can't be a bank fixed deposit, right? If you can get 6% in a bank deposit and pay 8% to a housing finance company, it makes no sense. So again, you will get a reasonable mortgage if you have good skills. Then that begs the question, should I pay more than 20% ever? The recommended down payment is 20%. Sometimes for a bigger, for a more valuable house, the banker will even accept less than 20%. But I think 20% is a nice, let's say, the sweet spot as to how much you put. Because when you put 20%, the lender is very comfortable saying, okay, he's willing to put 20%, so I have to lend him only 80%. I'm assuming, of course, you are in your mid-30s or mid-40s, and you're buying a flat and you got a longer runway for retirement. You got 15 years to go for retirement. You're going to retire at maybe 60. So you have time in which you're going to make the repayment. Most people will end up repaying in 8-9 years, though I would recommend, if you take a 20-year loan, go the whole 20 years, because by the time your equity markets will also have enough time to do well, recover, go through a bad phase, all that will happen. And if your equity market does very well, say it gets 60% return, you get 1 year, you know it's not going to sustain. Take a little bit of that and repay a part of the principal. So all these things. So let's look at the pros and cons. Should you put more than 20% down? When interest rates are higher, it's a no-brainer. If you're going to borrow money at 11%, why would you do that? Because that's the time when equity markets may not be doing too well. So that's the time maybe you should put down 40% and not 20%. There is, of course, one good plan by State Bank of India. I know once upon a time HSBC used to do it. I do not know whether HSBC does it now. Is to go and take an overdraft for buying a house. So you need a 10 crore loan or a 5 crore loan, whatever be the amount. They sanction you that amount and they open an overdraft account for you. As and when you leave money in the savings bank account, you can that much of the interest will go down, right? So if you keep money in your savings bank account, say you borrowed 5 crores and you have kept 1 crore in the savings bank account, then you'll be paying interest on 4 crores. Just change it. If it is a 50 lakh loan and you have kept 10 lakhs in state bank, in the saving bank account, this is a SBI product, then you pay interest on 40 lakhs. So this should be a very, very good product and very intelligent product, because you could use that money, buy a car and still get your section 24 deduction. Today the deduction is just 2 lakhs, so this game doesn't work. But once upon a time, this used to be a very good tax planning tool, that you do all your expenses. You even go on a vacation or whatever you do, from that account you keep spending. So your loan never gets repaid, except maybe to the extent that you pay the interest. And the State Bank of India couldn't care, simply because you were paying them interest, and they had the whole security of the house. So even assuming during good times, when interest rates are low and you can get good returns in your mutual funds, equities, etc., it makes more sense to put it there. But if the market goes to a downturn, you feel, oh, I should have repaid the account, so repaid the amount. So that SBI helps you, because you keep the money in the savings bank account, you're paying lesser interest, and suddenly if you think there is an opportunity to buy shares in the market, you can use that money. So if the more you put, the more your money gets locked in, and you're not able to use that money for anything else. So, but let us look at it this way: you are risk averse, and you might also consider putting more than 20%, because you are afraid to see the word debt in your books. The fact that your assets are growing at a faster rate does not help you. You say, oh my God, I got too much debt, I've got too much debt, I've got too much debt. Debt also, the way to look at debt is, see how many months salary or how many years salary is there. Don't say, oh, my father took only 2.5 lakhs and here I am taking 30 lakhs. Makes no sense. If your CTC is 10 lakhs, you're taking 3 years loan. If your dad's CTC was 80,000, you're taking 3 years loan. It doesn't really matter. You have to see how many years you will be able to repay. So, but there are some people for whom peace of mind is more important, than who hate the idea of having debt in material of what is the interest rate. Oh, my father never borrowed, my uncles never borrowed, we have never borrowed in our family. That's great, then don't borrow. I mean, I'm one of those people who never borrow to invest. Borrowing to buy assets is something inevitable. I didn't do it. I didn't borrow to buy a car, buy a house, buy an office, nothing. I never borrowed. I'm anti-borrowing. But let's say you're older and you don't want a mortgage, then makes sense to make a greater down payment and repay the loan faster. So you're 48 years of age and you want to repay the whole loan in 12 years, and the EMI would be too large if you put just 20%. So you want to put 40%. Yes, that makes sense, especially if you won't have much of a high income after you retire, and retirement could suddenly happen at 55 and not at 60. In such cases, whenever you get your PF, etc., take money from there and repay the loan. What are the potential drawbacks of a larger down payment? Is you will have lesser liquidity, right? You don't have money to invest, and suddenly if the market goes up, you feel, oh my God, I should have made a lesser down payment. So if you have some health issues and you need cash and you feel, oh, I shouldn't have paid so much. So depending on your liquidity needs, your age, how you handle debt totally, all that, and there could be some missed opportunities in terms of, oh, market's going up, you don't have enough money to take your own ESOP, your parents asked for money and you did not have the money to pay. But also remember that today there is no tax advantage of a mortgage payment beyond 2 lakhs, right? So it doesn't really matter. So you can make a down payment of 20%, you can make it higher, but what should you do if you make a down payment of 20%? Instead of putting your target amount down, you put 20%, take the balance and put it into some index fund or something and see and monitor what is happening. If you're getting, if you're paying interest of 9% and you're getting 12% in the equity market, you're doing well. So why would you then not continue that for a longer period? Or you decide, okay, end of 2 years or end of 5 years, you review and you find that you got 14% return in your equity and you were paying 8% return in your 8%. There are two ways to look at it now. Again, you say, okay, this is going fine, this is going on well, I'm able to pay my EMI, so let it continue. Or you take a small amount of money from there and say, let me repay, say, 5 lakhs of my principal. You had 50 lakhs, suddenly you say, okay, let me repay 5 lakhs of the principal. That's also not a bad thing, because again you see your debt shrinking. For many people, debt shrinking is a huge psychological advantage, right? You can make extra principal payments every year. Say, okay, every year when I get a bonus, I'm paying 23,000 rupees EMI, but I'm going to pay 2 lakhs as a repayment of the loan end of the year, or maybe 50,000 as out of my Diwali bonus. That can be another way to do. And when you put down only 20%, make sure that the remaining is invested, and your EMI will be higher because you made a lesser down payment. But if you have a surplus, again that money should go into mutual funds or equity or things like that, so that you get a return better than the rate of interest that you're paying to the bank. If you ask me, this is a very confusing video, and you must be wondering, what should you really do? Now this is, you will never get it perfect, no matter how much you decide to put down. Sometimes you feel, oh, I should have put more. Sometimes you'll feel I should have put less. Suppose you put less and you use the money in the equity market, and the equity market falls, then you feel, oh, I should have done the reverse. And sometimes when you make a higher payment and then you find that the equity market is booming and you got 32% and 34% in your portfolio, you feel I should have done the other way. So there is no one correct answer for this. You have to make your own choice, and out of the bonuses that you receive, out of the extra money that you make in the market, let's say you traded and you made 5 lakhs extra, you made 5 lakhs in 2-3 deals, and then what do? Repay part of the principal. So all these combinations will work. You have to take a decision based on that at that point in time. If you're going to judge me over 20 years, I'd say make a lesser down payment. But if you have uncertainty in your job, your spouse may be working, may not be working. If there are, let's say, your parents, your children, and your wife, which means 1, 2, 3, 4, 5, and you, if 6 of you are dependent on one salary, something going wrong is possible. So any answer which works for you is great. Thank you.